Dan, how have you thought about the concept of liquidity, both from a structuring perspective? Nick mentioned a few different structures and the corresponding liquidity structures as a result, as well as educating investors on the concept of liquidity. Welcome, Dan. Nick and I are excited to have you on. A lot to talk about. Would love to just start with your background and a brief overview of Vista as you build out the Evergreen suite of products.
Yeah. Well, first, Michael and Nick, it's a pleasure to be on. I'm a big fan of the podcast, so I'm really looking forward to the conversation today. Maybe I'll start with Vista, then I could talk about myself. So Vista was founded in the year 2000 by Robert Smith. Robert has a fascinating background. He was trained as a chemical engineer, studied at Cornell, actually my alma mater, and spent the early part of his career in engineering roles at Bell Labs and Kraft and Goodyear. After business school, went into tech banking M&A at Goldman Sachs. He was actually the first person at Goldman to exclusively focus on tech M&A and was working with companies like Yahoo and eBay and Microsoft and Apple in the early days of really the tech inflection point. And so Robert really had two realizations coming out of that early part of his career. One is the revolutionary power of software on productivity gains that really hadn't been seen in decades. And then two was all these companies were operating in different ways, and maybe not completely efficiently. And Robert really thought there was a way to apply best practices across all of these companies to help them grow. And so started the firm in the year 2000, really pioneer as the first private equity specialist firm, again, exclusively focused on enterprise software, and sought out to build this proprietary playbook of best practices to help software companies grow and create value. Fast forward to today, 100 billion in AUM. We've done 610 transactions over 24 years in the enterprise software space. We have over 300 people that are either investment professionals or value creation professionals that are out in the market every day thinking about enterprise software only. And we invest across the life cycle of companies. So we invest post-product market fit. So we're not doing venture or really growth equity, but post-product market fit from $100 million enterprise value companies to $10 billion plus enterprise value companies across the software spectrum and across both equity and private credit. We have a private credit business as well today. And again, back to kind of the secret sauce or what's in our DA, we're really an operationally focused company about systematic approach to value creation. And we have 100 people on that value creation team. And when we buy businesses, that team is implementing what today is now 100 best practices that are proprietary to go help these software companies grow. So that's Vista. As far as myself, I joined the firm in February of this year to build and lead our global private wealth solutions business. I've been in the alternatives private wealth space arena for 20 years now, so I've spent my whole career there. I spent the last 12 years at KKR, where I also worked closely with Nick in that capacity, where I was the first person hired to start and build KKR's private wealth business from scratch back in 2012. And so, thrilled to be at Vista today. I think it's an enormous opportunity, and we can talk about it more, but really thinking about how do we deliver enterprise software to individual investors.
That's where I'd love to go with this. And I think important in all of this, you've obviously had a relationship with Nick for some time at KKR, at Vista as well. And Vista is part of iCapital's iDirect fund. And so you've both seen each other in that context. And I want to hear from both your perspectives on what it's like to work together a little bit later. But, I think so important in what you said is software, particularly enterprise software, is such an interesting and attractive place within investing. Walk us through that thesis and why it's so compelling in a number of senses, right? Because you have, obviously, people know about public software companies. There's also many private enterprise software companies. What makes enterprise software such a compelling investment thesis, and why you've all focused on that at Vista?
Yeah, great question. So software is the largest and fastest growing sector in the global economy. It's growing at 17% and it's expected to be at 25 trillion in market cap by 2027. When you think about software, it really, where we invest in software specifically, we only invest in mission critical enterprise business to business software. So we don't do consumer tech, we don't do consumer software. Our view is consumers tend to change their minds pretty quickly, whereas enterprise software tends to be very sticky and resilient. And when you think about enterprise software, it's really enabling all sectors of the global economy. So it's powering hospitals and schools and supply chains, you name it, software is running our global economy today. And think of it as the utility that all of these businesses are run on. So we're investing in mission critical enterprise software. And because of that, again, it's a very resilient business model. You have typically very long-term contracts with recurring revenue. So when you think of the Vista portfolio, our recurring revenue is about 91% across the entire portfolio. Again, very sticky. When you think about customer retention tends to be very high because they keep using the product. And so I'll give you one example. PowerSchool is a company in our portfolio. It's the software that powers 80% of the schools in the US and across 95 countries in the world. It's helping, administrators, teachers, parents, students, lesson planning, homework, scheduling, you name it, the schools are running on these systems. So that's just one example. And software also has very low correlation from a revenue perspective to the market and to other software companies. So to the market, software revenues have a 0.08 correlation to the Russell 3000 and a 0.12 correlation to other software companies because, again, it's a very resilient, sticky business model. And so when you package this all together, you've got low correlation, you've got downside protection in the form of recurring revenue, and you've got this great growth opportunity as well. Then you add on top of that Gen AI, which we think software really becomes the beneficiary of Gen AI because software owns all the proprietary data that fuels these large language models. That makes it even more compelling. But the kicker really is when you look at the space, the issue for individuals is that there's 100,000 enterprise software companies. About 95% of them are private. So if you're an individual investor and all these attributes that I'm talking about, you're not getting access to that today.
It's a great lead into Nick. You obviously have thought about how to construct a portfolio for the wealth channel when it comes to building a set of evergreen funds. And you've also thought deeply about public and private. So Nick, would love to hear some thoughts, perspectives on that. Questions for Dan there as well.
Yeah, so, Dan just made a great point, right? That 100,000 software companies in the U.S. and 97% are private. There's been a lot of talk. We've been hearing about it, in the financial news, for years now. But the growth of the Mag 7 and the S&P 500 was initially designed as an ideal proxy for the total U.S. stock market, but now 10 companies are around 36% of the total index, and 5 companies represent something like 24% of the market cap of all U.S. companies. So just taking a step back maybe from software, and looking at the broader picture, private equity assets have increased tenfold over the last 20 years. And that's led to a fundamental shift in corporate ownership that doesn't involve the public markets. So the private markets, and this is what I think Dan was just talking about, they're now financing a larger part of the broader economy. And as a result, they're now home to countless large, mature, profitable companies. The changing roles, it's really sort of over the last 2 decades between public and private markets is pretty dramatic. Public markets used to greet the best and the brightest of the corporate universe. But today, by the time companies go public, they're well past their hyper-growth phase, and the innovation and the strong entrepreneurial cultures that historically described like a robust small cap universe, those companies are now being absorbed by the private markets and firms like Vista. And you hear more and more about the hollowing out of the small cap market. The Wilshire 5000, which is a broad measure of U.S. stocks, now holds 3,400 stocks, not even 5,000. I think something like 40% of the companies in the Russell 2000 aren't profitable. That's double the level from 20 years ago. So, again, there's been this dramatic change, and most people's portfolios don't reflect that, right? There's about 21,000 companies in the U.S. generating annual revenues of $100 million or more, and 87% of those are private. And that's obviously, as Dan said, a lot more pronounced in the software industry. So we always say, stick with the 60-40 portfolio. Just take part of the 60, the public stock portion of it, and diversify some of that into privates. And, that's really the role of these evergreen funds, right? The evergreen funds are extending access into private equity from the 2 million qualified personal households in America out of whatever 135 million households to the 14 million accredited households. And the simplicity of an evergreen fund, money goes in the ground day one. You have a monthly NAV, you have quarterly liquidity, you have simplified tax reporting, 1099s instead of K1s. That's really, I think, what we've been working very closely with Dan and Vista on, and also KKR and Warburg and, many other GPs who really, this channel's now important to them. They want to protect the integrity of their brands. They want to bring institutional style pricing to this marketplace. They want to deliver strong results. They're playing the long game. And that's what, the iDirect series is about. And it's really, this is, the biggest initiative underway at iCapital is really trying to, make these funds. And we think of these as sort of the generation 2.0, 1.0, 10, 12 years ago wasn't a particularly good period for alts in the wealth channel. But 2.0 is transformational. And that's what we've been doing a lot with Dan and Vista about.
I think there's so much in there for both of you to peel back the layers on. I think where I want to start is evergreens make a lot of sense in a number of ways. How does software investing fit well into an evergreen context, and why?
Software at the start is, again, very complementary to the evergreen space because most evergreen strategies today are generalist strategies. So when you think about the attributes that I just talked about as far as downside protection, you've got the growth, you've got the low correlation. First and foremost, it adds a nice complementary exposure to an existing evergreen exposure. The other thing I'd say is if you look at evergreen strategies, you can now use it in an asset allocation. So these attributes that I'm talking about that are very, very compelling for a overall portfolio construction before could really only be used at a moment in time for a private equity drawdown fund. Now it could actually be implemented on an ongoing basis. And then the other thing that I'd say for Nick and others is in an evergreen context, you can often construct it in a way that gets access across the full life cycle of deal flow or across different strategies, right? And so instead of just picking, there's a large cap fund or a mid cap fund, a small cap fund, you can actually amalgamate the deals from multiple different strategies, and so that you're getting diversified access. Again, as I talked about before, everything from a $100 million company to a $10 billion plus company. And then the last point I'd make is the efficiency that Nick talked about as well. You're fully invested day one. You don't have capital calls. And the most important component of being fully invested day one is you're compounding over the entire time period. Whereas in a drawdown fund, you're getting called and distributed, so you're never fully invested. Here, you're actually fully invested over a 10-year time period. And that compounding is actually very, regardless of whether it's software or another strategy, general strategy, the compounding is very significant for investors.
One follow-up there for Dan, and then I'll go to you, Nick, on this as well. You both mentioned how many of the companies that are generating 100 million revenue plus are residing in private markets. There's also a trend of private companies staying private longer, particularly in software and tech. How much does that give you an advantage on the deal sourcing and winning deal side in terms of having an evergreen structure to be able to match the desires of founders and operators who may want to keep their company private longer? And you go to enterprise software, just to add the final piece to this, is these are long-term recurring revenue type businesses. So maybe that matches well with an evergreen type structure for both sides, both the investor and the investee?
Yeah, we are the way the evergreen strategies work, they're investing directly alongside the fund. So the fund is the primary driver of selecting the deal flow and managing that within the portfolio construction. And then the evergreen strategy is able to take a piece of that component of a deal. But what is beneficial is now you're able to go to a founder with probably more assurance to say, hey, we can do this deal completely ourselves. Nick, I don't know what you'd say about that in your context as well.
Yeah, just the same thing, Dan. I think that, first of all, the elongation of private companies in the life cycle, that's really been maybe the biggest story over the last 2 decades. Previously companies, they'd have to go public, right, to fund their continued growth. And, now they don't need to. They can turn to the private capital markets. And, by staying private, the entrepreneurs and executives running these businesses, they can continue to focus on their long-term strategic goals. They don't have to worry about the distractions of quarterly earnings calls and the requirement to disclose financial information and key performance metrics to competitors. So it's very compelling. And as these companies have grown and gotten larger and larger, the private equity funds that have been fueling that growth have gotten bigger. So I think this is actually a really good example of this, right? This is what we've seen across, not just, funds like Vista that have, this was a very small number of players kind of bear hugged the SaaS movement, in the early mid 2000s. And a lot of companies that probably would have had a different ownership structure just ended up staying as a true partnership with these private equity firms. And many of these firms, again, Vista is an example, at the larger end of the private equity market got big for a good reason, which is that the investors rewarded the high performance by increasing allocations to future funds. So as they committed more and more capital, these managers were consistently sort of outperforming. They just moved up into the larger end of the marketplace. So, these companies that today are, in some cases, 5, 10, 15 plus $billion enterprise values, they're not going public. They have no intention of going public. And now there's the right level of partnerships and there's ample capital to fuel their growth. Will an evergreen fund hold on to an investment longer? It really depends on the private equity firm that, they're working with. So, in the case of the iDirect Private Markets Fund, it's really not our decision. We're allocating investing right alongside Vista and KKR and Warburg Pincus. And by the way, the mix is, the design there was, you have one of the pioneers of private equity in KKR, a leader in the upper end of the middle market, large cap leverage buyouts, which invests across sectors and geographies. You've got a similarly premier name, well-established firm focused solely on growth equity with Warburg Pincus. And then to Dan's point, Vista, you could argue whether software is the largest industry in the world. You can certainly make that case. But without a doubt, it's the fastest growing and it permeates every segment of the economy. So we really felt kind of that those three together, that was like the trifecta for someone who wants to begin their journey in private equity and have a well-diversified portfolio where there's full transparency. This is really one of, a very few number of evergreen funds where you can look in and see exactly where your money's going. The managers you're deploying with, the underlying strategies. And so it's really up to them, because they're the ones originating these investments and overseeing these portfolio companies. They decide, when they're going to exit, when they're going to monetize those investments. But for sure, in an evergreen fund, that works well. You can hold longer. So
yeah. And Nick, one thing I'd add to that. So I was talking about it mostly in the context of an evergreen strategy, but 2 points to add on what you were just talking about. So since October of 22, we've done 5 take privates. So the markets, particularly in software pricing, came down. And we have 5 companies that said, hey, we think we can partner with Vista. We can go into the private markets. We don't have to deal with the quarterly reporting as much, and we can take a long-term view. And that was a great entry point for us as a firm. So those companies are now private. And then if you think about the small medium-sized end of the spectrum, there's over 4,000 late-stage venture companies that were backed by venture firms. 60% of those were funded 2 to 4 plus years ago. So those companies are now running out of cash runway. The venture and growth equity market is a little bit on the sidelines, and they're looking for both capital plus a partner to grow. And so again, Michael, to your point, these companies, they want to stay private. They want a partner to grow. You've got our 100 people in value creation, our 100 best practices. All we do is software. They're looking at us to help take them to the next level. Maybe it's a mid-sized company, we call it an adolescent, and we're looking to grow them into a mature adult.
Well, that brings up an interesting point too, not just in the context of evergreens, but as you've built your firm at Vista, you're a scaled specialist. So you don't just do big buyout, you don't just do growth equity, you also have credit now. There's a bunch of other strategies you have. How have you thought about the development of different types of products to serve different types of companies? One, just as it pertains to the way you provide capital and grow your own firm, but then two, how you've thought about that in the context of building evergreen strategies around those different provision of capital.
Yeah, we do the same. We have the same approach regardless of size. But when you think about it, a $10 million revenue company has very different needs than a $10 billion revenue company, and depending on which segment we're investing in, whether it's small, mid, or large, we're applying our resources just in a little bit of a different go-to-market manner. So we're investing across small, mid, and large in private equity. And then in private credit, what you're seeing right now is there's a lot of these, really quality companies that they're not ready to go public. They don't want to raise a down round or take dilutive equity. And so they'd rather come partner with Vista to get credit and still be able to tap into our resources for credit and still have that growth capital to go invest in increasing their sales force or marketing or whatever it may be to help continue to grow that business. And so it, depending on, the strategy that we're investing in, it may differ, but it's really the same playbook that we're applying across everything. And then from an evergreen perspective, we've got a view that investors either want growth or they want yield. And so I think it's important actually to separate the two. I think if you combine the two, then you're just going to bring down the target return for the equity vehicle, and you're still not going to be able to deliver enough yield for the yield buyer. And so our preference, similar to how iDirect is set up, is that's a pure play equity vehicle, and then you could have a BDC for a yield buyer. And so that's how we're thinking about it. But at least in the private equity context, we think there's an ability, as iDirect is doing, to be able to take deal flow across that small, mid, large equation to be able to get everything in one vehicle.
Yeah, and Nick, you've referenced this before, the importance and advantages of being a scaled specialist. When you thought about partnering with Vista, creating the iDirect fund, why was it important in your mind to have a scaled specialist?
So it goes back a little bit, Michael, to what I was saying before, in terms of the benefits of scale, and as the entire private equity markets matured over the last decade, there's clearly a growing advantage to operating at scale, right? You can greater recruiting firepower, right? Hiring and retaining not just the most talented investment professionals, but also large teams of operating executives. Vista has an enormous team of software specialists who work right alongside the investment professionals. As these firms get bigger and they're around longer, there's just sort of broader and deeper sourcing networks that are developed as a result. And then there's greater investment in infrastructure, right? So that's data, technology, risk management systems. So it's, we actually looked at this analysis. I think a number of firms have done, using data from Preqin, PitchBook, Cap IQ, different sources. But for the decade from 2010 to 2019, large buyout funds outperformed all other fund size cohorts across a variety of metrics, including pooled net IRRs. And to us, it wasn't surprising. We've been watching the maturity of this industry. And by the way, as Dan noted earlier, the ability to write large checks, big enough to keep some of these large-scale, high-growth firms private, these firms are doing that today. They're taking public firms private. They're doing things that, 2-3 decades ago just weren't possible in the private capital markets. And when you're doing that, when you're playing up in that end of the marketplace, there's less competition. So there's fewer players going for those large companies because they can't aggregate the capital to take them private or to write a check to a private company that may have a $5, $7, $8 billion enterprise value or even more. So there are some benefits. Having said that, obviously a lot of great performing, private equity firms that play down the lower end of the middle market. In the middle market, and when you look at like the top decile, you see a large, cluster of some of these smaller managers there as well.
And when you're in an evergreen context, you're always on. So you're taking in capital constantly. And so if you want to be in the evergreen space, you have to have scale to be able to deploy that capital. We have the benefit of being a $100 billion firm. We're deploying about $8 billion a year across our private equity platform. So we have the scale, we have the consistency of the deal flow, but then we are still specialized in what we do. I do think this market will continue to evolve to have more specialists doing evergreen strategies, but you have to have the scale in order to be able to do that. And I do think the investor base will start to have exposure to the more generalist strategies, and then we'll look to diversify by adding specialists. But again, it's going to have to be specialists that have the scale as well.
So I think that's such an important point, and one that both of you have to figure out. You're both running your own races in terms of building and creating evergreens, but you're also working together in that context too. So I'd love to hear from both of you, Dan, what you just cited, which is you have to always be on. How much harder, from both of your perspectives, is it to run and manage an evergreen structure relative to a closed-end structure?
I would say it's harder. There's just different considerations. And at the end of the day, it's all about performance. That is what drives, that's what we're here for. And so if you raise too much, you're just going to sit in cash and you're not going to be able to deploy the deal flow. That's going to dilute the performance. And so it really requires all GPs in this space, Vista, others, to really analyze and be thoughtful about what is the appropriate scale for this vehicle. Looking back, what is our transaction pattern and history? How much dollars are we deploying over a certain time period, over many years, over the last year? What's the consistency of that deal flow on a monthly and quarterly basis? How do you think about packaging that deal flow into an overall portfolio construction? And then you really need to match that with, okay, based on the historical facts, based on our current pipeline of what we see right now, here's how we think we should scale this vehicle. And I really think it's important not just to be out there raising all dollars and then having sitting in cash, or to be deploying and underwriting, reducing your underwriting standards. And so I wouldn't say it's more difficult. It just takes different things of measure as far as when is capital coming in, how much liquidity do we have, how do you portfolio construct in an evergreen concept versus in a closed-end concept. And so those are all really important things that all of the firms that are doing evergreen funds are building out and getting very sophisticated on.
Yeah, Michael, you've heard me say this, I think, many times, but the interquartile spread in private equity is massive, relative to stocks and bonds. It's, and that's the spread between the highest performers and the lowest relative to the stock market or the bond market. As a result, your ability to outperform, if you can just get one thing right, is tremendous, and that's manager selection. So the average illiquidity premium of private equity is 250, 300 basis points over the public markets. But your ability to achieve, 400, 600, 800 basis points of outperformance really depends on your ability to source and then access the top tier managers. And those managers like Vista, KKR, Warburg, et cetera, the one thing that they're very good at is they're very disciplined in terms of the entry multiple when they come into companies. And in private equity, you're not paid to market time, right? So you have to deploy capital throughout all cycles. So those sourcing networks and that, your historical data and your ability to understand, where you are in the point in a cycle and, where it makes sense to stretch and where it makes sense to step back and wait for the next deal, and not overpay in a frothy marketplace. And then lastly, with the direct access program that we put in place, we get to see deals, deal by deal, like top of the waterfall, every deal that these three GPs, in the case of the iDirect Private Markets Fund, make. So we can come in side by side, just like a big institutional SMA with institutional style economics, into all of those deals. So what that allows us to do, among other things, is minimize the cash drag for an evergreen fund. So we can reliably keep the cash down around 10%. In fact, we can even keep it like a hair below 10%. And we never have to worry about unfunded commitment liabilities. We never have to worry about sitting on 20, 30% cash. And that's incredibly important in operating an evergreen fund.
Yeah, Nick, you make a good point on discipline. I think that's also a benefit of being a specialist. I mean, we see every deal that's happening in the enterprise software space because we're so known for being a big player in that space. We see a lot of deals that many others won't see in that space. There's often times when we'll have spent 3 years with a company before we actually do a transaction. So we can be very selective in what deals we do, and then again, match that with the capital need by being selective about how we scale an evergreen vehicle.
What you're talking about, so much of this discourse here is really about how do you educate investors on the merits around this type of structure and the type of investing you're doing. What would you say has been the most challenging aspect of educating the wealth channel on evergreen structures?
Yeah, I wouldn't say it's challenging in the sense that it's constant and it's omni-channel. So it's not just one way. It's meeting with financial advisors one-on-one. So that's having a team of people out in the market, in local markets that can be working with financial advisors. I tend to find those one-on-one meetings are the most interactive, and you can really educate on a personalized basis. Then you've got events, either events hosted by firms like an iCapital or a private wealth firm that you can go speak at and help educate, or events hosted by the asset manager themselves. And then you have what I'll call content and digital, right? So there's content that could be developed, white papers that are put out. There's been a plethora of this over the last several years being done. You guys, Nick, have a great white paper on the world is moving towards evergreen. I'm probably messing up the title.
I think that's a seminal paper in the space. That was actually, for context, that was the genesis of this whole idea of doing this evergreen series, was the paper that Nick wrote with Steph from Hamilton Lane on this.
Yeah, so I think there's a lot of great content.
How about you, Nick?
Yeah, same thing. It's certainly omni-channel. I think it's never ending. It's, we've been educating the wealth channel for now over 11 years. We have an online program. It's in a non-for-profit. It's a joint venture with Kaya. It has 10 modules. Each module earns an advisor a CE credit. It's all sort of broken down, and we try and avoid using industry acronyms and, phrases and things that, might lose an advisor's attention. But also just going out in the field. To Dan's point, the most effective way is always in person. One-on-one meetings, it could be going to conferences. It could be holding breakout sessions and just talking about, what is private equity? How does it work? What's the utility of private equity? And of course, it's the white papers. It's constantly, you hear lots of questions. People want to know, is there too much dry powder out there? The cost of leverage is or capital is rising. How's that going to impact returns in private equity? So we're always writing, blogs, white papers, trying to address that. And then there's product-specific education. So there's just education where, an advisor leaning into a fund, he or she wants to introduce it to their clients, but maybe as a little bit of a speed, but maybe there's it's almost like a little exam. They take a look at this, short overview of the fund so that, everybody fully understands the liquidity constraints, the fee and expense structure, how the fund operates. Very different from like the IDD piece of it, the investment due diligence, where you're really doing the deep dive on the manager, their historical track record, the team consistency. I think it all begins there when you're finally down to the point where you're making a decision on a fund, but then making sure that the advisor, particularly when you're a large institution and you have a suite of offerings that are made available, to possibly hundreds or thousands of advisors, you want to make sure that they have that product-specific training. And that's what it is. It's just training on the product.
Nick, you mentioned the term liquidity in what you said. I want to ask you, how do you think about educating LPs on liquidity in the context of evergreen structures?
Yeah, well, there's a phrase that is now pretty commonplace, semi-liquid, right? So these 40 Act tender offer funds fall under semi-liquid. The 40 Act interval funds, which is where you typically find credit, it's also semi-liquid. Non-traded REITs, non-traded BDCs, private BDCs, the 3C7 kind of evergreen products. I always tell people that that these vehicles are still, they should think of them as illiquid with some liquidity features. So yes, it's 5% per quarter. In the case of tender offer funds, very important that people understand if there's a market meltdown, if there's a run on the markets, those funds will gate. They have independent boards, and I think they're very candid in saying that. They're not going to fire sale private assets in that climate. So they're actually doing what's right for the underlying investors. Interval funds, by the way, are different. The main difference is that the 5% quarterly liquidity is mandated in the case of interval funds. So they actually have to honor that regardless of market conditions. So it's really important to understand that. The liquidity is at the fund level, typically, not the individual investor level. But I think it's an important point. And, I always tell our team to make sure that, people understand that before they put any clients into these funds.
Dan, how have you thought about the concept of liquidity, both from a structuring perspective? Nick mentioned a few different structures and the corresponding liquidity structures as a result, as well as educating investors on the concept of liquidity.
Yeah, I mean, you can, depending on the structure, you can set the liquidity parameters where you want. Interval fund, as Nick said, is the only one where you absolutely have to provide that level of liquidity. And so depending on, in credit, you may feel comfortable absolutely providing that level of liquidity, but in private equity, you may not feel comfortable. And so that may dictate whether you go interval fund or another type of structure. I think the industry has done a very good job of educating on liquidity so far. There have been circumstances where managers have hit proration, and I think the financial advisors and clients have actually well understood the parameters. What I say is similar to Nick. This is not liquid private equity, right? You need to think of this as a long-term investment. Yes, there's 5% available per quarter, but you really need to have a long-term mindset here. And what I like to talk to my team about is that should be discussed in every conversation. You should never have a conversation where an advisor is going to go have a conversation with their client without understanding that feature that I talked about. And then the next piece of it is there's been some innovation in the last couple of years where there's been additional soft locks that have been put in place for a longer period of time. In some cases, it's 2 years. And if you redeem within the first 2 years, there's you're coming out of discount to NAV, or there's a little bit of a cost to redeeming during that time period. I think that further really enhances the conversation with the advisor, because now you really have to have a conversation to say, listen, this is meant for long-term investors. If your investors come out in the first 2 years, this is what will happen. And that also really forces the financial advisor to engage in that conversation with clients. So I think it's all about really making sure that is discussed up front and is not a surprise.
Yeah, we always tell, just like you said, Dan, we always tell people, think of these as, 5+ year holds. If you look back 80s, 90s, average hold period for a mutual fund was 5+ years. So we just tell people this is, and for advisors, it sort of instills a buy and hold discipline on, the underlying investor. So it's a win-win, but you got to hold, because again, private markets are slower to mark up. They're slower to mark down. Generally, it's a smoother ride, a lot less volatility. But that value appreciation happens over time. So it's almost silly to look at these things every quarter. How did it do last quarter? It's really about picking the right managers, making the right decisions up front, and then holding it for an extended period of time. And if you've made the right decision, you will see that NAV grow.
So that's a great lead into the last question I'll have for both of you. Why do each of you think that the future is building evergreen strategies?
Nick, do you want to start?
Sure. Well, first of all, one is just simply, the number of investors that you can reach with evergreen products. So again, I said it at the outset of this podcast, but if you're going directly into a private equity fund, private credit fund, whether you're going directly or whether you're going in through a feeder, it's restricted to qualified purchasers. Those are individuals who have $5 million of investable assets, excluding their primary residence. And that's 2 million out of, again, 130 plus million. These evergreen products are built for the mass affluent. They're built for the 14 million accredited households. And some of them, the interval funds, many of these interval credit funds now, they generate a daily NAV, they trade on a ticker, they can go sub-accredited. So almost anybody can invest in those. So the way we look at it is you're really opening up the private capital markets to a lot more investors, and it's just all simplified, right? It's built. These were built for this market. So again, money goes in the ground day one. They're much lower minimums. I mean, private equity funds typically have a $5 million minimum that's designed for institutions. So feeder funds takes that down typically to 100,000, but a lot of these funds will have minimums of 10, 25, 30,000, but low minimums, 1099s instead of receiving a K1 in August and having to file a tax extension. And again, you're getting a monthly NAV. It's really built for the market. Now, this is maybe a good pass off to Dan. In 5-7 years, are all these going to be trading on a ticker? Are we going to see a real transformation in the marketplaces?
First, you've got the world is also moving towards individual investors. So there's reports out there that anticipate 60% of the assets in the entire industry will be with individuals by 2030, and that's up from 45% not many years ago. So the world is moving in that direction. And as Nick said, it's just a much more efficient way for people to get exposure to the asset class and to have compounding over time. And so what I see happening is what happened in credit and real estate first. People moved into REITs and BDCs, and I think the same is happening in private equity and infrastructure over the last couple of years, particularly with the advent of some of the newer launches that have been out there. And so as I see the world going forward, I think it'll happen with private equity and infrastructure as well. Those will become the core way that individuals will allocate. I think there's an opportunity that even small, medium-sized institutional investors that don't have big staffs that can manage the cash flows and liquidity and capital calls, some family offices will move in that direction. Like, hey, we like distress at this moment in time, and we want to allocate to that. But I just think it's a much more efficient way, particularly for financial advisors and individual investors to portfolio construct. And the last thing I'll leave you with is when I think about it from my own personal perspective, you never know, did I commit too much? Did I commit too little? When do I get a capital call return? I'd rather just take my bonus at the end of the year and take a portion of that and put it into this and let it compound for 10 years. And if I'm saying that, then most other individuals are probably thinking the same way. And that, to me, that is the best way I can describe it. So I'll leave it there.
No, this was fantastic. Great conversation with you both. Nick and Dan, thank you so much, guys, sharing all sorts of different vantage points, ways of thinking about evergreen structures, which I think is so important. And you both mentioned it, educating people on this. And that's the goal of this, is to help people understand this space and the merits of it, as you both discussed just now, why this is so important. So Dan, Nick, thanks so much for coming on this series. Fantastic episode.
Thank you for having me. It's been a pleasure, and I'll do it any other time.
Thanks, Dan.
Likewise. Thanks, guys.
The material herein has been provided to you for informational purposes only by iCapital Inc. iCapital. This material is the property of iCapital and may not be shared without the written permission of iCapital. No part of this material may be reproduced in any form or referred to in any other publication without express written permission of iCapital. This material is provided for informational purposes only and is not intended as, and may not be relied on in any manner as, legal, tax, or investment advice, a recommendation, or as an offer to sell, a solicitation of an offer to purchase, or a recommendation of any interest in any fund or security. You should consult your personal accounting, tax, and legal advisors to understand the implications of any investment specific to your personal financial situation. This material does not intend to address the financial objectives, situation, or specific needs of any individual investor. Alternative investments are complex, speculative investment vehicles and are not suitable for all investors. The information contained herein is an opinion only, as of the date indicated, and should not be relied upon as the only important information available. Any prediction, projection, or forecast on the economy, stock market, bond market, or the economic trends of the markets is not necessarily indicative of the future or likely performance. The information contained herein is subject to change, incomplete, and may include information and/or data obtained from third-party sources that iCapital believes but does not guarantee to be accurate. iCapital considers this third-party data reliable, but does not represent that it is accurate, complete, and/or up-to-date, and it should not be relied on as such. iCapital makes no representation as to the accuracy or completeness of this material and accepts no liability for losses arising from the use of the material presented. No representation or warranty is made by iCapital as to the reasonableness or completeness of such forward-looking statements or to any other financial information contained herein. Securities, products, and services are offered by iCapital Markets, an SEC-registered broker-dealer, member FINRA and SIPC, and an affiliate of iCapital Inc. and Institutional Capital Network Inc. These registrations and memberships in no way imply that the SEC, FINRA, or SIPC have endorsed any of the entities, products, or services discussed herein. Annuities and insurance services are provided by iCapital Annuities and Insurance Services LLC, an affiliate of iCapital Inc. iCapital and iCapital Network are registered trademarks of Institutional Capital Network Inc. Additional information is available upon request. Copyright 2024 Institutional Capital Network Inc. All rights reserved. iDirect Private Markets Fund, iCapital Registered Fund Advisor, LLC, the advisor SI, an affiliate of iCapital Markets, LLC, serves as the investment advisor to the iDirect Private Markets Fund, the fund. The advisor is registered as an investment advisor with the Securities and Exchange Commission. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. The advisor is exempt from registration with the Commodity Futures Trading Commission as a commodity pool operator. The advisor became investment advisor to the fund on February 12, 2021. Before February 12, 2021, the fund was managed by a different investment advisor. Before February 1, 2022, the Stepstone Group LP, Stepstone, served as sub-advisor for the fund. However, as of February 1, 2022, Stepstone is no longer the sub-advisor for the fund. For detailed information about the advisor's services and fees, please read the prospectus of the fund, which can be found at https://www.sec.gov/edgar/searchedgar/companysearch.html or call 855-891-0092 to request a copy. Investors should carefully consider the investment objectives, risks, charges, and expenses of the fund before investing. This and other important information about the iDirect Private Markets Fund is contained in the fund's prospectus, which can be obtained by calling iCapital at 877-562-1686. The prospectus should be read carefully before investing. Past performance is no guarantee of future results. Investors should be aware that iCapital Markets, LLC, provides distribution services to the fund, and that iCapital Markets, LLC, does not provide services to any investor, including any determination regarding whether an investment in the fund is in the best interests of or is suitable for any investor. Investors should exercise their own judgment and/or consult with a professional advisor to determine whether an investment in the fund is advisable. Copyright 2024 Institutional Capital Network Inc. All rights reserved.